Rates. Interest rates are the star of the show. And I hate talking about rates. It's the most boringest thing. It's really out of everyone's control. And in general, rates are what rates are. But it definitely is impacting the market some. And knowing kind of where that's at, especially how much that we've had to move up recently, does impact the psychology of buyers because we're meeting with them. They're expecting a certain rate or certain payment. They don't track rates, right? They have no idea. And people buy on payment. So as that rate shoots back up, that affects what people feel like they can afford. And it's good to know, in my opinion, what does the data show that it's likely going to be as the year goes on? Remember, there's no way to know for sure. Also, there was an interesting article that came out with the top 10 overpriced markets in the United States, and 5 of those were in Florida. Some of these markets are good to know. And it's good to know because this is what people are reading in the data out there. And I'll give you my opinion on the data. And then last and most importantly, what I call your DSP, your daily success plan. I've met with a lot of agents lately. I see some people just knocking it out of the park, and I can share with you what they're doing that seems to be working and maybe some ideas of what you can put in place, especially as this year goes on. So let's look at rates first. That's kind of, to me, the star of the show right now. This is Mortgage News Daily. It's just an idea of a site. Now, keep in mind with rates, I look at banks' rate sheets every day. If you take all the fancy footwork, all the marketing, all the craziness, they're pretty close. It's pretty competitive. It's not like one bank's at 7 and other bank's at 6. If they are, they're playing with the cost of that particular loan. But again, every situation is different. This is just a site I like to look at. Today's mortgage rates, this is as of last week on Friday. 30-year rate was at 7.14%, back to a 7 handle. So if you look right here at this chart, look at this just shooting up here. So I put it at 1 year. This just, to me, always mind-boggling. I've been doing this a long time. You just don't see rates shooting up the way that they do lately and down. You can see these big drops down and up. So that shows you how fast it can move. Back up over 7%. And if I shoot back here 5 years, you can see just how high rates have gone. And now we're kind of at this peak here again at 7%. This is an article from Redfin saying housing market update. Mortgage rates surged past 7.1% for the first time since November. Some buyers back off while others lowering their budget, which obviously makes sense, right? Rates are going up. Some people are going to not buy because they think the rate's too high. Other people are going to say, well, I can only afford X amount for a payment, regardless of what rates do. And on my end, qualifying people makes it difficult because I got to keep going back and looking at all these pre-approvals, and people are buying a lot of times to the max of what they make, and then now we may have to take them down and say, well, instead of 450, now you're only qualify for 425. So that can get difficult as well. So it's a lot to keep track of as rates bounce up and down. Now, when we look forward, there's a lot of data that's going to be coming out. The Fed right now, when they meet again, there was a 98% chance, at least that's what the market was betting, that the Fed was going to pause. They were not going to raise rates. They were just going to pause. As of last week, it's up to a 67% chance of hiking rates again, which is just in a week, huge difference. That's because of a lot of the data, this debt ceiling. And I've been of the mind that after July 1st, we're going to see a decline in rates, and we're definitely going the wrong way right now. I actually still believe that I'm going to be in the ballpark correct on that. And that's because a lot of data comes out, CPI, core, all of these inflationary numbers. There's a thing called base effect, which you can look up, but it's just the way they do the averages, and the numbers that are rolling off most likely means that we're going to get a better CPI report and a better core inflation report, right, of looking at inflation and kind of where it's headed, right? That's what the Fed is looking at. And I still think the Fed will pause, meaning they won't raise rates again. Whether they raise rates or not doesn't mean it will directly influence interest rates. It's going to matter more what they say during those meetings. And I really think we're going to get more recessionary pressures going forward. And I still think as of July 1st, I'm going to call that kind of the peak. And I'm not the only person saying this, so I read a lot and listen to other people and get their opinion. And of course, it's just my opinion based on that information. But I think you could draw a line on July 1st, and we're going to start seeing a gradual trend down from there. Who knows how fast? And I think, again, rates will be under 6%, closer to 5.5% by the end of the year. That may be optimistic, but we will see. So what's the opportunity, right? That's always what I like to look at is rates have shot up kind of at the worst time, right in the middle of summer when people are locking in rates and shopping, for a home. But it is what it is. So what's the opportunity? What's the conversation to be having with buyers? The answer is the same thing the answer has been really for the last year, which is higher rates is an entry point into a less competitive market. Every time rates have gotten under 6.5%, closer to 6, mortgage applications have shot up. That shows you how much things are tied to rates right now when they're in this 6 to 7% range. I also think there's not a lot of meaningful supply. Right here, NAR talks about nationally, contract signings are flat, more inventory critical. And they're right? Because even though inventory has been building up, that's a little bit because demand has started to pull back. I think we're down 42% nationally, for drop in demand since this whole thing started. So that's just a ton of drop off in demand. So we are getting some increases in inventory, but not meaningfully enough to move the needle. And I think as rates fall, the rates have to fall to a certain point to get supply back online in a way that matters. And so I think you're going to get more competition. There's more programs coming out. Ron DeSantis just redid the Hometown Heroes program. And so as you push more buyers in the market, rates fall, it's just going to create more and more people that are going to compete for the same amount of few houses that there are on the market. So I thought that was good advice to be talking to your clients about. I've had this conversation literally 20 times in the last couple of weeks is, look, you're going to be refinancing either way. Most likely, there's no guarantee. So when rates are high, at least you're not competing with as many as people. And I'll actually look at rates or look at payments with the buyers at different rates so they could see where their payments could be if rates fall. And I really think that's what when I'm talking to clients, I say, if you buy looking at a 7% rate, your chances are if rates are going to be lower, what your competition is doing is looking at what will my payment be if it's a 6% rate. And you at least want to take that into account when you're buying right now, because you want to be refinancing when rates are that low instead of competing against buying a house when a bunch of other people are. So that has kind of become my mantra when I talk to clients is when rates are higher, there's less competition. As rates fall, obviously you want to refinance. Last thing, article that I thought was kind of interesting here. Top 10 overpriced housing markets in the U.S. They put right here how they calculated this, comparing the average expected home values based on historical trends to the average list price across 100 of the largest metros. I mean, basically that means that they're taking the average and how we compare it to the average in that trend. And to me, it makes sense Florida would be on this list a lot because there's so many people moving to Florida that I think our averages are thrown off, because just like places like California and those places are seeing people migrate from there. We're one of the states that people are migrating to. With that being said, here's the top 10 overpriced markets according to this article that's going around. I've seen it on a couple of different websites. So 10 is Nashville, Tennessee. Number 9, Tampa, Florida. And you can look here, I'm not going to go through each one, but average list price is $361. Expected home value they thought would be $252. So that's a big increase. Number 8, Deltona, Florida. Number 7, Detroit. Number 6, Palm Bay, Florida. Number 5, Lakeland, Florida. 4, Memphis, Tennessee. 3, Charlotte, North Carolina. 2, Cape Coral, Florida. And number 1, Atlanta, Georgia. Those are the top 10 overpriced markets. According to the article, again, I think it makes sense Florida would be on this list because our averages are way out of whack with so many people that are moving here. A really good question to be asking yourself during all of this craziness is, the market is as the market does. Someone said, is the market good or bad? The market is what the market is. There's always opportunity. I know realtors that are crushing it. I know 3 realtors that had their best month in history last month. So again, every situation is different, but a really good question to ask yourself is, what is my daily success plan? And I would say 3 things about that. 1, if you can't say in language what your daily success plan is, then you probably don't have one. And that doesn't mean it can't be a combination of things. An idea, maybe you don't have a great daily success plan if there's too many things, right? You need to do a few things really well. I was just talking to someone that does social media, and man, their plan and how mapped out it was, the posts they're doing, I mean, it blew my mind. So whatever your plan is, the more you can refine it and say it in language, then you actually have a plan that you can execute day after day after day, regardless of what the market does. And that is the last thing I'll say about a daily success plan, is that it really shouldn't be that market dependent. There are tweaks that you need to do depending on what the data says. But in general, if you're making phone calls, you're just going to make more. If you're doing posts and different social media strategies, you need to do more. So you probably do need to turn the volume up on things depending on the situation. But having a daily success plan gives you what to do every day, regardless of what the market is doing. And if you don't have a daily success plan, Make sure you join us on our classes every Tuesday. It's the biggest online gathering of agents in the United States. We have different agents coming on sharing exactly what they do to have the best open house, to do the best post, to do the best Facebook, whatever it is. Learn from people that are already doing it. I think that's the best way. If you have any questions on this or anything else, let me know. It's Rayce Robinson, your favorite Florida mortgage broker. Have a great week, and I'll talk to you soon. Bye-bye.